investing veteran Satish Rai, Senior Advisor at OMERs and former CIO at both OMERs and TD Asset Management. Thank you so much for joining me,
Thank you
Satish.
for having me. This is wonderful to be here.
And I remember talking to you a couple of years ago. We were trying to understand this rate environment, and we all thought it was temporary, right? We thought we're going back to 0%. And I remember speaking to you and saying, we're positioning the portfolio at the time you're still CIO for higher for longer.
Yeah.
So now here we are a couple of years later. Would you still say that's the guiding light? Whether we get 1 or 2 rate cuts, you still have to think about we're not in a zero interest rate environment anymore.
Yeah, I think most investors since 2008 to today have really been accustomed to very low rates. And I think that's an anomaly. And I think the best way to think about it is that there is a transfer of wealth from savers to borrowers, and now we're normalizing that. So whatever the rate cut might or might not happen at the Bank of Canada, you should budget for and expect that interest rates will be at least 3 to 4% at a minimum for the next number of years, barring a global crisis. So, and you don't want that. So you should hope for and expect for something normal that's 3 to 4% higher than it was in the past, but not as high as we've had in the last couple of years.
What does that mean for assets? Because that distortion of zero interest rate policy made a lot of things possible, right? Yeah. Particularly in public markets, these hot IPOs. And now what? If you're in this 3 to 4% interest rate environment, what do you have to think about in terms of asset allocation?
So it's really simple. The really strong companies are going to do very well, and the companies with poor balance sheets or poor business models are going to struggle. And you've seen that play out, especially in the technology space. The tier 2, tier 3 companies that don't generate cash are going to struggle. The tier 1 companies that are generating cash are going to go do very well. But I think that translates across the economy. So anybody that owns a home that doesn't have high debt levels will do okay, because they can actually put some money into a GIC or some money in their savings. So anybody that gets the benefit of having a little bit of money to save is going to do better. Anybody that has excess debt, whether it's a corporation, whether it's a government or individual, is going to suffer a little bit more than they have in the last 5-10 years.
Some of the most cashed up people right now, including pension funds, but also private equity. And would you say that the growth of private assets is maybe just beginning? Because we hear a lot about this, right? Is that people should be looking more at allocating to alternative or private assets. Certainly the pension funds have been doing that.
Yeah, so the good thing about OMERs and many of the Canadian pension plans is that we started the journey of investing in private assets 10 years ago, 15 years ago. Today, when you invest in private assets, you really have to ask yourself, are you investing because you can leverage the balance sheet, or are you investing because it is a really great asset? And I think for the last 5 or 7 years, private assets got this tailwind from lower rates and higher leverage ratios. So today, you don't have that tailwind anymore. You have a headwind where rates are a little bit higher. And so if you're investing in private assets, there's nothing wrong with that. They're out to do well. But anybody that has high debt levels are going to really, really struggle the next 5 years.
So your guiding light is cash flow. So you have a business that you don't have to lever up in cash flow. That sort of debt-fueled era is essentially not on your radar anymore.
Correct. Anybody with excess debt, whether it's real estate, private equity, infrastructure, is going to struggle. And anybody that spins off cash, any corporation that spins off cash, will do much, much better.
We've seen a big push, big growth in private debt because, the banks are constricting. So it's actually become a lucrative market to be a lender, an alternative lender.
For pension funds, the private credit space is almost the perfect space for the perfect time, in that we can now achieve returns of 6, 7, 8, 9, 10% in private credit, really well thought out, really, well researched. And that meets our liability stream. And so for about 10 years, we could not invest in an asset class because it did not meet a liability stream. Yeah. So you had to invest in some of the other asset classes. Today, the liability stream for most pension funds, let's say, is 6, 7%, or maybe 5%. So if you can achieve credit, which is senior on the capital stack, you're better off going there than you are on the equity side.
Is that where we're going to see a lot of growth from the pension funds? Because, of course, since the financial crisis, and OMERs famously did this with venture, right? Yeah. You needed that alternative. And so conservative pension funds started to dabble in venture. Do you see, money coming out of venture and going into private credit because it meets the criteria a little bit better?
The really great thing is that all asset classes are going to grow in dollar terms, and all geographies are going to grow. We're going to keep investing in Canada, keep investing in the United States, and keep investing in ventures. what happens is, so the pie that's growing as an asset class is going to be, it has been credit because it kind of works. But that doesn't mean we're taking asset classes away from other ones. The whole pie grows, but a disproportional amount of pie goes towards credit.
So we've been talking asset classes. What about geographic exposure? What's your 2 cents on this movement to get pension funds like OMERs and others to invest more in Canada and to be champions of what we grow in this country?
Well, first of all, OMERs would welcome the opportunity to invest more in Canada. We have Yorkdale Mall, we have Bruce Nuclear Plant, we have office towers, we invest in public, private, we have private businesses. So if there's opportunities in Canada, we're all there. And, you know, I think it's been a little bit misleading that saying that we only invest in, let's say, 5% in public equities. But our total investments in Canada are like 30%. And so when you add up all the private investments that we have, we're actually really focused on Canada, and we continue to look for opportunities. But we, as a fiduciary, also look everywhere in the world. And we don't really say we want to be investing in all of Asia. We want to invest in all of Europe. We pick very specific countries and very specific areas. So, for instance, in real estate, we might be in Germany, and we might be in Berlin in Germany. We're not across all of Germany. So for us, it's really throwing very fine numbers at the company and the opportunities we have, and not a broad area. But our focus remains Canada's our home, and we continue to invest in that area.
What if they say, I don't know who they are, regulars say it should be 50%, it should be 60%?
You know, I think that you're always going to have people who go zero, because our economy is only 3% of the world economy. We can debate if it's 20, 35, 50. I think we've found a pretty good balance, and I think that's worked out well for our pensioners. Because
you do have that landscape with OMERS Ventures, specifically that area of the market has been up in arms about the increase to capital gains tax inclusion rate. A bit of a mouthful there. Your thoughts? A lot of people come on and say this is going to damage innovation. Then there's others who say you need to pay it forward. You know, there's people who can't eat in this country. Yeah.
So first of all, the venture space was predominantly based out of the United States, and Canada was a relatively small player in the the North American scape. The concern that I have is that as a percentage of the pie in North America, our venture space won't grow. And we are a very small part
because of this increase.
Well, because there's a lot of areas, and because the innovation, whether it's San Francisco, the opportunity set, the U.S. market's much bigger. When you win the U.S., you win by a factor of 10. When you win in Canada, you win by a smaller factor. So we really need to do everything we can to give us a leg up on the venture space or any type of investments. So anytime there's a hurdle, it just slows down the progress that we have. So the comment I'd make is do everything you can, and taxes, taxation is one thing, to encourage investment in Canada, to encourage development, to encourage job creation. And anytime you put up a hurdle, understand that makes it harder and harder for those investors to invest in our home country.